Hello. Welcome to our next chapter, that is your NR taxation. So I know everybody has been waiting for your NR taxation. Okay, so let's start without doing any time waste. So first of all, this chapter starts with identifying who is a resident, who is a resident, who is a non-resident, who is resident and ordinary resident. Okay, so all of that we will be doing. Okay, so first of all, to identify whether a person is a resident or not. So basically, there are three conditions. So first condition you have to check if the stay in India, if the stay in India is equal to or more than 182 days in the previous year. If it is equal to or more than 182 days in the previous year, you will automatically become a resident. Okay, now what if your stay in India was less than 182 days? In such a case, you have to check both of these conditions together. That means both of them should be satisfied. So both of these conditions are a and condition, and these three are a or condition. That means either satisfy the first one or satisfy both 2 and 3. Okay, so what is 2 and 3? That is stay in India. Stay in India is greater than or equal to 60 days in the previous year. So if in the previous year your stay in India was less than 182 days but more than 60 days, either equal to or more than 60 days, and stay in India is greater than or equal to 365 days in the last 4 previous years. So what are they saying? So either in the previous year you stayed for 182 days or more, you will become a resident. Okay, if you don't satisfy this condition, then you have to satisfy two conditions. Both of them you have to satisfy. That means, which is stay in India in the previous year. Stay in India in the previous year should be at least 60 days. That is 60 or more days. This is your condition number two. And your condition number three is stay in India in the previous last 4 years. In the 4 previous years should be equal to or more than 365 days. So only and only both of these conditions are satisfied will you be treated as a resident. So either satisfy only condition 1 or satisfy condition 2 and 3 both, then you will be treated as a resident. Okay, next is your resident and ordinary resident. So if once you satisfied the condition of resident, then we will check whether are you a resident and ordinary resident or you are not. So in such a case, there are two conditions. That means both of them have to be satisfied. This is a and condition. So your first condition is resident for 2 previous years in the last 10 previous years. So out of the last 10 previous years, you should have been considered as a resident for at least 2 previous years. And second condition is stay in India is greater than or equal to, what you have to notice in all of these limits, it shows greater than or equal to. So therefore, stay in India is greater than or equal to 730 days in the last 7 previous years. 730 days. Okay, so we've done 60 days. So we done 182 days, then we did 60 days, then we did 365 days, and now we are doing 730 days. Now this 730 days is in the last 7 previous years. Only and only both of these conditions have been satisfied will you be considered as a resident and ordinary resident. Okay, great. So now since our bases are clear, let's move on. Let's move on to some special cases. Your special case, there are basically two special cases. First is when an Indian citizen leaves India during the previous year. When he leaves India, for which purpose? Either for the purpose of employment outside India, or as a crew member of an Indian ship. He has to be a crew member of an Indian ship. Only and only if he's left for these two purposes. What does the act say? That to check whether you are resident or a non-resident, to check you will only consider this first condition, that is your 182 days. That means to check whether you are a resident or not, both of these conditions will not be checked. Therefore, it says only check 182 days limit for your NR. Only and only check this 182 days. Both of these conditions will not be affected. Okay, so you have to ignore your conditions 2 and your condition 3. That means to check if he is a resident, only and only check whether did you stay in India for more than 182 days or equal to 182 days in the previous year. If he says no, then finish. You do not have to check these two conditions. This was your special case 1. Now your special case two is when an Indian citizen or person of Indian origin. So Indian citizen or person of Indian origin. Indian origin means when your parents were born in your undivided India. So Indian citizen or person of Indian origin outside India in any employment or profession visits India. That means he is already working outside. He is all in case one, if you see, this person was in India and he is going outside India. In case two, he is working outside India and he comes to India. So Indian citizen or person of Indian origin outside India in any employment or profession visits India. So in such a case, if he visits India for a period of 119 days and less, if he visits for a period of 119 days and less, he will be treated as a non-resident. If his stay does not touch 120 days, he will be treated as a non-resident. Simple condition. Okay. If his stay is between 120 and 181 days, if his stay is from a range from 120 to 181 days, in such a case, he will be treated as a resident. But if stay in India is greater than 365 days in 4 previous years, stay in India is greater than 365 days in 4 previous years, and your MTI, that is MTI is your income but excluding your foreign income, if that exceeds 15 lakhs, that means if both of these conditions are satisfied and his stay in India is for a range between 120 to 181 days, only and only in such a case he will be treated as a resident but not ordinary resident. Therefore R but NOR, resident but not ordinary resident. Okay, and what if he does not satisfy these conditions? What if he stayed for a period from 120 to 181 days, but he did not satisfy these two conditions? In such a case, he will be treated as your non-resident. That means he will go back. He will go back to this slab. Okay. Now next is your resident and ordinary resident. That means if the person has stayed for a period of 182 days and more, if this person has stayed in India for a period of 182 days or more, and satisfy the R and OR condition, that means this condition that we studied, if he satisfies these conditions, only and only in such a case will he be treated as your resident and ordinary resident. Basically, what did we do? For this person also, we only check this condition. These conditions we have cut. So therefore 182 days satisfied resident. If your these conditions are also satisfied, then you will also be an ordinary resident. Okay, I hope this is clear to you. Now your person of Indian citizen, will be treated as resident but not ordinary resident. Person who is a resident but not ordinary resident, if income other than foreign sources is greater than 15 lakhs, if income greater than 15 lakhs and not liable to tax in any other country, if the other country, if this person is not liable to tax in any other country and his income, his NTI excluding your foreign income is more than 15 lakhs, what do we do? We tell him ki come, you come to us, we'll take tax from you. Okay, so person of Indian origin will be person of Indian citizen, person who is an Indian citizen. Remember, it is not Indian origin over here, it is only Indian citizen, therefore I've cut it. So person of Indian citizen who is resident but not only resident if income greater than 15 lakhs and not liable to tax in any other country. Next is your while calculating stay in India, while calculating your stay in India, include the days on which he enters and leaves India. So the days on which he enters and leaves India, those days will be counted as residing in India. Okay. Exclude both days if he is a crew member. That means only in case of crew members will these both the days, that is his date of arrival and date of departure, both of them will be excluded. Otherwise, for everyone else, both of these days will be included while calculating. Okay. Next is how do you find for HUF? So how do you find for HUF whether it is a resident and ordinary resident? So it is a small table. So for HUF you have to check that the control and management. If the control and management is wholly outside India. If it is wholly outside India, in such a case it is a very easy case. It is a non-resident. Now what if it is wholly or partly in India? Either some parts are in India or the entire control and management is in India. So in such a case, you will check the Karta, that is the head of the HUF. You will check if the Karta, if your Karta is a resident and ordinary resident, if the Karta is a resident and ordinary resident, the HUF will also be treated as your resident and ordinary resident. And if your Karta is not your resident and ordinary resident, that means if he is anything other than resident and ordinary resident, in such a case, the HUF will be treated as resident but not ordinary resident. So since some decisions either wholly or partly are being taken in India, it will still be considered as resident. The only doubt is whether it will be ordinary resident or it will be not ordinary resident. Okay, so therefore it is ordinary resident and not ordinary resident. Great. So this was your HUF. Then next is your section 89A. This was a newly added section. So section 89A says relief from taxation of income from retirement benefit account. So all the amount that you transfer to PF, etc. So this has an international taxation side to it. So person resident of India, person who has a resident of India who opened an account in some countries are mentioned, that is your Canada, UK, Northern Ireland or USA. These four countries, if a person who is a resident of India had opened an account where either in Canada, in UK, in your Northern Ireland or in your USA with respect to retirement benefits, for example, say gratuity or PF account they had opened while being a non-resident of India. That means it is possible that this person was working outside India, he was working abroad at that place, and he had to open an account. So during the time when he was working outside India, of course, he was a non-resident over here. So retirement benefits while being a non-resident of India will be taxed on accrual or withdrawal basis as per the choice of SSC. So it will be the SSC's choice. It will be the SSC's choice because now he's a resident of India and that income will be taxable. So he has to, it will be his choice that when he wants to pay tax, when he accrues the income or when he actually withdraws the income. Okay. Now next, so we've already done finding the state for HUF. Now we are doing for company. So what you have to first remember that your Indian company, if it is an Indian company, it will always be a resident. No conditions attached. If it is an Indian company, it will always be resident. You cannot check number of days of stay in India because it is an Indian company. Any other company will be a resident only and only if your place of effective management, that is we also call as POEM. So any other company will be considered as resident only if your POEM is in India, only and only if your POEM is in India. So now this POEM, this place of effective management, you have to check that where is the company, from where is the company actually being effectively managed. So what is the place of effective management? So what you have to, first of all, the point that you have to remember, POEM to be checked. This effort you will only put only and only if the turnover is greater than 50 crores. Only and only if the turnover is greater than 50 crores will you check for the POEM condition. So first of all is step one. Step one says POEM will not be in India. POEM we will consider, that is your place of effective management is not in India. We will consider only and only if you satisfy both our conditions, because this is an and condition. So you have to satisfy both of these conditions. Only then will I agree that your place of effective management is outside India. Now what are these two conditions? First condition is majority meetings of board shall be held outside India. Majority, if the majority meetings of the board are held outside India, and active business is also outside India, that means your business meetings are also happening outside India and your active business is also outside India. Both of these are satisfied. Only then we will consider that yes, maybe POEM, maybe we are still saying maybe POEM is outside India, that is place of effective management is not India. Okay, so we will see what active business means. First, we'll just finish this process. So, okay, so if step one convinces you, if both of these conditions, remember, both of these conditions have to be satisfied. So if step one satisfies you that yes, POEM is outside India, then you will check step two. So only check step two if step one shows outside India. What does step two says? Identify the place of board meetings are held if the place of such person making decision, that is the person who is making decisions in the board meeting, is outside India, only and only if the place of such person is also outside India, only then we will consider that yes, your poem is outside India, you are not a resident of India. Okay, so therefore you have to satisfy two steps. First of all, in step one, there are two conditions. You have to satisfy both of them. Only then we will consider you as outside India. And second is that the person responsible also during the meetings, he should also be uh, outside India. Only then will we consider that your poem is actually outside India. Okay, now let's see what does active business outside India mean. What do you mean by active business? So basically, they have specified four limits. First is assets in India. Assets in India shall be less than 50% of total assets. That means if your total asset size is, say, for example, 100 crores, your assets in India should be less than 50 crores, not even equal to. Okay, what you have to pay attention is out of these four conditions, three of them have a sign that is less than, but your fourth condition has less than or equal to both of them. So therefore, to satisfy in first three conditions, it should be less than, and fourth condition, it can also be equal to, it is still allowed. So assets in India should be less than 50% of the total assets. That means assets in India plus assets outside India. Your employees in India shall be 50%, shall be less than 50% of total employees. Your payroll expenses in India, payroll expenses. First we did over here when we were doing the number of employees. Now we are doing payroll expenses. That means your rupees also, your payment also. So payroll expenses, that is the salary that you pay. Payroll expenses should also be less than 50% of the company's total payroll expenses. And last is your passive income. Passive income in and outside India. That is passive income, for the purpose of passive income, if you see over here, it is both in and outside, both of them are included. Over here it is only in. Okay, so what you have to remember for passive income, basically your passive income breaks two rules. First of all, it is not just less than, it is also less than and equal to. And second is passive income, you have to calculate both in and outside India, because they will give you questions. Remember, you have to take outside India also. So passive income in or outside India is less than or equal to 50% of your total income. Now, what is your passive income? Passive income is transactions where purchase and sales are both associated enterprises. That means the person who's buying and the person who's selling, they are both associated to each other. We've already done this in transfer pricing as to what an associated enterprise is. We made a small table. So transactions where purchase and sales are both to your associated enterprise. And second type of your passive income is your interest, dividend, and rent, because these are not related to business. So your interest, dividend, rent are also considered as passive income. Now next, if you see, I have put some asterisks over here. These asterisks are used for calculation. That is, use average of previous year and last two previous years. So you have to use average of the previous year and last two previous years to calculate these figures. Okay, next is what income will be taxable to what people. Okay, so I made this into a table format. So your Indian income, whether accrued or received, Indian income, whether accrued or received, that will be taxable to everybody. Okay, so it is taxable to all of these. Indian income, basically you have to remember that Indian income is taxable to everybody, whether you are resident and ordinary resident, not ordinary resident, non-resident, I don't care. Indian income, whether accrued or received, it will always be taxable to everyone. Now next, confusion only comes for your foreign income. So for foreign income, it is, you have to divide it into two types of income. One is business or profession controlled from India. So it is foreign income, but business or profession is controlled from India. And second is your other foreign income, that is anything and everything except this. So first is your business or profession controlled from India. So now what do you have to see? That for resident and ordinary resident, for individuals and HUF, for a resident and ordinary resident, everything will be taxable. Your Indian income, your foreign income, your any income, all of that will be taxable. So therefore, for resident and ordinary resident, whether it is from business or it is from other, everything is taxable. Okay, now what about resident but not ordinary resident? For resident but not ordinary resident, only income earned from business or profession controlled from India is taxable. Other foreign income will become exempt because he is not an ordinary resident. Okay, now for NR, for non-resident, none of this, your foreign income will not be taxable. India will not touch it. So therefore, both of these, there is no tax. Only in on the Indian income, we will charge tax to the NR. Otherwise, the income that he earns, that is he is not a resident, so he does not have to pay tax. Now, individual and HUF is done. Now, what about other? That is your company, etc. So, if you are a resident, all your income is taxable. If you are a non-resident, none of this foreign income is taxable. Okay. So, how you have to remember for individual and HUF, or you are a company or any other, if you are resident and ordinary resident, everything will be taxable. If you are resident but not ordinary resident, your Indian income though will always be included, always be taxed, but your business or profession controlled from India will also be taxed, and all your other foreign income will not be taxed. And last is your non-resident. That means only and only Indian income will be taxable. Rest all foreign income will not be taxable. Great. So now there are some transactions where income will be deemed to accrue or arise in India. That means this one. So even though income has not actually accrued or arrived in India, but because of law, we will deem this income to be accrued in India. So first is any income accruing or arising outside India from. So from these three things, if your income is coming, it will be treated as income deemed or accrued to arise in India. So first is any income from property in India. For example, if you purchase any houses and you get rent from those houses, so now this will be taxable and this will be deemed to accrue in India. Second is any business connection in India. Income related to business connection in India will also be treated as income accrued or arise in India. And last is your capital gain on assets situated in India. Any capital gain on asset, that means on selling the asset that you get the gain, that will also be treated as accrued or arise in India. Now, how you have to take, what do you mean by business connection? It is such a vague term. So agents in India wholly working for him, it will be considered as business connection. Advertisements which target customers in India, sale of data collected from person residing in India, and sale of goods and services using the above data. So all of these that I've read, these 4 points that I've read, they will prove that there is a business connection in India. These points that are marked as X, these mean that just because a person is purchasing goods in India for export does not mean he has a business connection in India, because he is only purchasing goods in India for the purpose of exporting only. Next, news collection in India or transmission outside India, this will also not be treated as business connection in India. And last is shooting for cinematography films in India, that is for anything for cinema. If people from outside come to shoot for cinemas, in such a case, it will not be termed as business connection in India. Okay. Now next we are doing is salary income or service rendered in India. So any service that you render in India, the salary income will be treated as income deemed to accrue or arise in India. Next is salary received by Indian citizen from your government for services rendered outside India. So if any government employee goes outside India, now whatever we are paying him, so salary is received by Indian citizen from government for service rendered outside India. We are going to pay him for the services he is rendering outside India. For example, if he goes to some embassy, so we will still be paying him salary outside India. So now, even though we are paying this salary outside India, it will be still be treated as income deemed to accrue or arise in India. Even though he has stayed outside to earn it, it will still be considered as income deemed to accrue or arise in India. Except perquisites. For example, if we've given him a car, we've given him a chef, we've given a house, whose rent we are paying. So now all of these are perquisites. So we will not be charging these, we will not be taxing these, but whatever remuneration, whatever salary he gets, that will be charged. Your perquisites will not be charged. Next is dividend paid by Indian company outside India. Any dividend paid by an Indian company outside India, this will be treated as income deemed to accrue or arise in India. So whoever receives this dividend, this income in their hand will be treated as income deemed to accrue or arise in India, and that income will be taxable. Next is interest received. Interest received by a non-resident who has loaned money to. Okay, so what you have to listen very carefully. There is a non-resident. Okay, there is a, this is your NR. So now your non-resident has, say for example, this is DHEER. Okay, so if your non-resident has lent DHEER some money, now it will depend what is DHEER, whether DHEER is a resident or whether DHEER is a non-resident, whether DHEER is using this money for what purpose also. Okay, so interest received by a non-resident, of course, your non-resident is giving me a loan, non-resident is giving DHEER a loan, so DHEER will pay the non-resident interest. Now the question comes that this interest that DHEER is paying to the non-resident, this interest, is it income deemed to accrue or arise in India for in the hands of your non-resident? This is the main question, because I will be paying him, Dheer will be paying him interest. So if the resident, if Dheer in this case is a resident, so if there is a resident who uses this loan in India for any purpose, if a non-resident, if a non-resident has given a loan to a resident in India, now this resident utilizes this loan for any purpose does not matter. In such a case, the interest that the non-resident receives, this will be taxable in India. It will be deemed to accrue or arise in India. Okay, now this was if Dheer is a resident and uses it for any purpose. Okay, the loan is used for any purpose. Now, what if Dheer is also an NR? If Dheer is also an NR, that is, both these transactions are taking place between NR and NR. Okay, so this point we've done. Second, if non-resident who uses the loan in India, that is, Dheer is also non-resident who uses the loan in India for business purpose, only this loan that I'm receiving, only and only if this loan is used for business purpose will this income be taxable to the NR. Only and only then will the interest that he earns will be treated as income deemed to accrue or arise in India. Only if this loan is related to business purpose, otherwise it will not be added. So if to summarize it, if a non-resident gives a loan to a resident, the resident can use it for any purpose, does not matter. The interest that the non-resident earns, that will be income deemed to accrue or arise in India. Now, what if non-resident to non-resident? Now, non-resident to non-resident, that means non-resident A gives the loan to non-resident B. Now, this B is using this loan for business purpose. If he is using for business purpose, this income that NRA is receiving in the form of interest, this will be treated as income deemed to accrue or arise in India. And if it is not used for business purpose, then it will not be added. Okay. Next is royalty received. Royalty received by a non-resident from a resident or non-resident. Okay. Of course, the same case over here also. First I had taken Dheer as resident. Next we took Dheer as non-resident. So royalty received by a non-resident from a resident or non-resident, it is the same concept as interest. Fees for technical services provided by a non-resident this should be provided to a non-resident from a resident or non-resident. This is also same concept. And gift received by a non-resident from a resident, it will be deemed to accrue or arise in India. So if a resident gives any gift to a non-resident, this will also be treated. It will be treated as income in his hand, and it will be deemed to accrue or arise in India. Okay. Now next is your section 1023 FE. 1023 FE says that your dividend, interest or LTCG from debt, share or unit. So any long-term capital gain. So first is any dividend that you earn from stock, any interest that you get from bonds or loans, any dividend interest or LTCG, that means on selling the assets, if you get a long-term capital gain from your debt, share or unit, it will be exempt for your some specified people. Now, who are these specified people? These three people These three people are your specified people. That means it will be exempt to these people. Okay. First is your wholly owned subsidiary of Abu Dhabi Investment Authority. Any wholly owned subsidiary of your Abu Dhabi Investment Authority, it will be exempt for them. Sovereign wealth fund and your pension fund. So these three specified people, it will be exempt for them. What will be exempt? Dividend, interest, and your LTCG. Your LTCG on your debt share unit. All of this is exempt. Okay. Now next is your taxation of NRI. NRI is your non-resident Indian. So now your NRI, what is the difference between your NR and your NRI? So NR we've already done. We figured how to bifurcate your NR, your resident and your resident and ordinary resident. So your NRI, taxation of NRI, first you have to identify who is an NRI. So your NRI is a non-resident who is also an Indian citizen or Indian origin. So a non-resident who is also an Indian citizen or Indian origin, this person will be treated as NRI, that is non-resident of India. Okay, if asset purchased in forex, that means if the asset, if whatever asset that this person has purchased, if it is purchased in in another currency that is other than rupees. So if the asset is purchased in your foreign exchange, your TTBR and TTSR provisions to be applied. So this is your buying rate and this is your selling rate. So if you remember, while doing capital gains, we had done this TTBR and TTSR. If you do not remember, please go back to the video and timestamps are on the video. So TTBR and TTSR provisions to be applied. Next is LTCG. LTCG from forex asset will be taxed at 10%. Any LTCG that you earn from your forex asset. Now you will also have to understand what is a forex asset. So LTCG from forex asset is 10%. Investment income. Just a second. Hmm. Any investment income from your forex asset will be taxed at 20%, and all other income will be taxed at your normal percentage. So you have to understand that any LTCG will be taxed at 10%, and any income that you derive from that asset, that will be taxed at 20%. So if you sell the asset, it will be taxed at 10%, provided it is your long-term capital gain, not a short-term capital gain. Okay. So LTCG taxable at 10%, income taxable at 20%, all other income taxable at your normal rates. So now you have to understand what is the forex asset. Forex asset is an asset purchased in foreign currency. It is an asset purchased in foreign currency. You get no indexation and you get no 6A deductions against this income. So it is an asset purchased in foreign currency. You will not get indexation. You will not get any 6A deductions. Now, what are your forex assets? Any share of public or private company, both of these are allowed if it is purchased from your foreign currency. So any share of public or private company, debenture should only be of public company, deposits of Indian company which should be a public company. So what you have to understand that your debentures and your deposits of Indian companies cannot be of private companies. Only it is allowed if it is of a public company. Okay, next is your securities of central government. So basically your forex assets are of two types. One is your share, debenture and deposits, and other is your securities of your central government. Okay. Now they are given a separate benefit, that is your section 115F. 115X talks about LTCG is exempt. LTCG will be exempt if that is whatever this LTCG that we are also charging at only nominal 10%. This also we will exempt when, that is when the asset that we have sold, whatever money they've received, if from this money they buy another asset. So how much of this portion will be exempt is LTCG that you have to pay. LTCG that you have to pay into cost of new asset upon net consideration. So for example, if you used your entire net consideration, that means your cost of new asset and your divided by net consideration, it will be 1 because you have used entire. So that means your entire LTCG will be exempt. Basically, they are showing a proportion. If you sold an asset, say for example 1000 rupees, and the new asset you purchased only for rupees 300, that means you use only 30% of your income. So since you use only 30% of your net consideration, we will also give you only 30% exemption of your LTCG that was payable. So you LTCG into 30% will be what is exempt. Okay. And this newly purchased asset, this new asset that you are purchasing, new purchased forex asset shall not be sold for a period till 3 years. It shall not be sold for a period till 3 years. Okay, you cannot do that. You purchase it today and then you sell it tomorrow and you're like, hey, 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 all done. No, you still have to wait for a period of 3 years. Otherwise, all of this exemption that we are giving, this will be reversed. So this is your section 115F. Okay, now another thing that is that you have to study on your own is there is a list of exemptions given. There are some exemptions given in this chapter, that is some I think 20-25 transactions have been specified that if these transactions are done, it will not be taxable. So make sure you learn those from your main book, whichever faculty's books you are referring. So if you are referring BB Sir's book, so you will find those in the compact. So you don't need to learn them. You don't need to learn these exemptions. Just read it twice or thrice so that if it comes in the paper, it strikes you that boss, this I had studied in my exemptions. Okay, so this is one part. This is one part that is not there in NR taxation in these 50-page notes. So make sure you read it from the main book. And lastly, to make this chapter more easy, I have made a table. I have made a table of all the rates that are applicable to them for your NRN foreign companies and your financial institution income. So if you find any more rates, do let me know in the comment section and I will add it to this PDF. So interest on your RDB, that is your rupee denominated bonds, interest on RDB or bonds issued after 1st April 2020 in your IFSC, the rate is your 4%. All other interest, if in foreign currency loan, all other interest, if in foreign currency loan, this is taxable at your 5%. Interest on foreign currency bonds of Indian company, interest on foreign currency bonds of your Indian company or your foreign currency GDR, that will be taxed at your 10%. Interest on foreign currency loan from government or any Indian concern, that will be taxed at 20%. So interest on foreign currency bonds of Indian company, if you are getting any interest from bonds of an Indian company, that will taxable at 10%. But if you are getting interest on foreign currency loan from government, it is your 20%. Okay. Next is your regards to royalty and FTS. So royalty and FTS, you have to check if PE is in India, that is your permanent establishment. If permanent establishment is in India, this is your section 44 DA. So if it is in India, it will be taxed at your normal rates. Normal rates. Now remember, whenever you are taxing them at normal rates, you will be taxing them at the net amount. That means your income minus any expenses that they've incurred, you will allow them to subtract. Only then you will be charging them at normal. So therefore, you have to understand that N for normal, N for net. By netting, I mean any expenses that you incur to earn this income, we will allow you to subtract it, and then we will calculate the tax. Next is if PE is not in India, if PE is not in India and there is no CG approval, or there is no CG agreement, this will be given to in the question as it is, that CG agreement exists or CG agreement does not exist. So if there is no CG approval or agreement, this is your section 115A. So 115A says that if there is no CG agreement, in such a case, it will be taxed at 10% as the gross figure. That means no expenses deduction will be allowed. And if P is not in India, but there is a CG approval or agreement, if there is an agreement, so this comes under against your section 115A. In such a case, it will be either taxed at 10% of gross. So this agreement is your DT agreement that we are talking about. So it will either be taxed at 10% gross or DTA percentage, that is whatever percentage has been specified in DTA, that is also gross, whichever is lower. That means you will not get any deduction for expenses. So 10% of your gross income or your DTA percentage, whatever has been specified, whichever is lower. Next is overseas Overseas financial organization income, that is taxable at 10%. Any dividend that you earn, if dividend is earned from your foreign currency GDR, that is your global depository receipts. So your foreign currency global depository receipts is taxable at 10%. All others are taxable at your 20%. LTCG is taxable at 10%. Any income of sports or entertainer, for example, for IPL, we are calling people from outside India to commentate. So any sports or entertainer, now this will be taxable at 20%. Your UTI or your mutual fund income, your unit trust of India or any mutual fund income, that will be taxed at 20%. And your lottery or horse race will be taxed at 30%. Okay, so this was your tax rate for NR and foreign company. Now next is financial institution income, and with this we will be done with the chapter. So LTCG 112 and 112A, if you remember 112A, we have already done all of these sections while studying capital gain. So 112A is your long-term capital gain on your securities on which STT has been paid. Remember that there is a special provision for 112A, that is only in excess of 1 lakh will be taxable. So over here your rate is 10%. STCG 112A, 112 is again the same, that is on which STT has been paid. This will be taxable at 15%, and your normal STCG will be taxable at 30%. Any interest or dividend from a non-specified fund will be from 20%. Interest or dividend from a specified fund, of course it is a specified fund, it will be taxed lower. So instead of 20%, it will be taxed at 10%. And last is interest for your rupee denominated bond, that is from your RDB, that will be taxable at 5%. And with this, we are done with our chapter. And I hope you got a grip on this chapter, and please definitely solve questions because it is a very important chapter. And I'll see you in the next video.